Good day to all. Today we're going to discuss about financial statement and cash flow analysis. We will divide this into two parts. The first part is all about the financial statements introduction, and then the second will be all about cash flows and our financial statement analysis ratios. So, to begin, we need to look back with our financial statements in terms of the approaches. Now, these are actually known also as bases of accounting. We have two, the accrual-based approach and the cash flow approach. For the accrual-based approach, this means that revenues are recorded at the point of sale and costs when they are incurred, regardless or not necessarily when a firm receives or pays out cash as said here. Or simply put, we have to recognize the revenue or income as we have provided the performance obligations or POs with respect to the contract. So example, if the contract is all about services or rendering of services for a service concerned business, it is when we are able to provide or render or deliver the services. On the other hand, if we say sales of goods, so it is when we have delivered the goods to our customers and we have performed substantial performances of our contract. So basically, those are the basic or fundamental concepts about the revenues. Then this is, of course, going to disregard as to whether we have basically received cash. And on another hand, for the expenses, we have to recognize them when they are incurred. So when really there is gross outflow of economic benefits in the company. Revenues are gross inflows of economic benefits as discussed in our financial accounting and reporting with respect to conceptual framework. So this is just connecting our concepts from our financial accounting topics because basically financial statements are from there. And then again, expenses are to be recognized when incurred regardless of when we have paid them actually. On another hand, for a cash flow approach, that's the opposite. So timing of cash flows is very important. When we have received money or cash or forms of cash, like example, even money transfer, like for example, in the Philippine setting, we have the money order transfers coming from Palawan, from RD, and also part of cash, basically, if they can be encashed immediately, as well as checks, which can be encashed in the same day. So basically, that's cash to begin with. And then for expenses, when we have basically paid using cash. This is used by financial professionals to focus attention on current and prospective inflows and outflows of cash. So in other words, the cash flow approach is very concerned about the timing of cash flows, whether inflows, also known as collections or receipts, and of course, cash outflows, also known as payments or disbursements, or even the word expenditures. Expenditures are synonymous to outflows of cash. All right, so for financial statements, basically we have our list from here, but in this source, this is the format. However, in our financial accounting and reporting, the list of financial statements have already been revised. So this is basically US GAAP. However, for our international financial reporting standards or the UK GAAP, we have different terms, which we are now following in the Philippines. Philippines is using the International Financial Reporting Standards. However, we can still make use of the terms from here since they do mean the same, or again, synonymous. That's the term that we are using. So example is balance sheet. Balance sheet would show to us our financial position or condition as of a given period of time. So balance sheet is also known as statement of financial position in IFRS. Income statement, on another hand, would show to us our performance or the bottom line or the result of operations, whether we are profitable or not. Profitable, so we will be shown the profit. That is when income or revenues are greater than expenses. And then loss would be when expenses are greater than income or revenues. So income statement is old term of statement of comprehensive income. Statement of comprehensive income in our IFRS though would extend not only with the bottom line or performance, but would also include items of other comprehensive income for the current values. So before the cumulative, if we say cumulative, meaning combination of the amounts of the items of other comprehensive income and other components of equity. So they are from there. Now the current amounts are shown in statement of comprehensive income. For the third item here, statement of retained earnings, this is okay if, for example, we are using the old versions of our accounting standards. However, for the current version, we are now using statement of changes in shareholders or stockholders equity, which would show three changes and accumulative amounts of our share capital, other comprehensive income, and retained earnings, also known as accumulated profits and losses. Basically, retained earnings is the account for the combination of all profits and losses of the entity all throughout the years or the life of the business. And then statement of income or profit and loss plus retained earnings is allowed under IFRS if ever there are only minor components, like for example, profit or loss and dividends. However, if there are now other components of equity like other comprehensive income, we don't have any choice but to really follow our current version of accounting standards, and that is statement of changes in shareholders or stockholders equity. Next then is statement of cash flows, in which it's okay because that is still the term, that is still the name that we are using even in the current versions of our accounting standards. And the last one of financial statements would be the notes to financial statements, which would show compliance to our accounting standards, the accounting policies employed by the company, our specific components of the line items found on the income statement and balance sheet and other financial statements. So example would be what are the components, let's say, of cash and cash equivalents. We will be saying that in the notes to financial statements. Also, other disclosures and other information. So that's for financial statements notes. Then that's the fifth one. For balance sheet, this would show again the financial position of the company as of a specific point or period in time. So it's like a snapshot as being said here. We can see it actually, and we can see the balancing of our accounting equation, assets equal liabilities plus stockholders equity. Stockholders again now known as shareholders. So at all times, the two sides would be equal. Assets composed of current assets and non-current assets. Liabilities would be the current and non-current ones. And shareholders equity, as said a while ago, share capital, other comprehensive income, and our accumulated profits and losses, formerly known as retained earnings. Then this is an example of a balance sheet or statement of financial position of Global Petroleum Corporation or GPC. So this is a comparative balance sheet. If we say comparative balance sheet or statement of financial position, or if we say comparative financial statements, we need at least 2 years for us to be able to compare. Under the asset section, we have current and the fixed assets. Fixed assets actually is the US GAAP term for the IFRS term that we are using now, property, plant, and equipment. So we can see such here about property, plant, and equipment, and then intangible assets like franchise, patent, etc., and the other assets. So we have here the total assets on the side. That's the left. On the right side, we have the liabilities and stockholders' equity or shareholders' equity from current and non-current or long-term liabilities, and also with stockholders' equity. So we have the preferred stock or preference share, common stock or ordinary share, as well as the other components of our equity or shareholders or stockholders' equity. If we add liabilities and SHE, we will get the total liabilities and stockholders' equity. The two sides must always be equal. Next, our income statement would show to us again our profit, earnings, or margin as explained a while ago. And this is our classic formula for this. Income equals revenue minus expenses. Revenue is also known as income, but we have the term here income. So the income for revenue is the gross income. And then, but if this is, for example, a merchandising or manufacturing concern, gross income is somehow going to be having a different meaning. So the revenue now would be sales. Sales and then minus cost of sales equals gross income. All right. So anyway, the revenue here would mean the sales or the service income, meaning the gross of all the grosses of income. And then minus expenses equals our profit or loss. For the income, the measures could be, I've said a while ago, gross profit, that is sales minus cost of sales. Cost of sales meaning being part of our expenses. Operating profit would be our revenue minus operating expenses, since there are expenses that are not part or considered of the operations of our business. So example of that would be the finance costs or expenses, and also with our income tax expenses. However, do not confuse this with financial accounting and reporting, because we do understand that even finance costs in the form of interest expenses, bank service charges are under our operating expenses. So that's financial accounting. But when we analyze now under our financial management topic, so we can introduce this concept of operating profit or income. Other income, so all other sources of income for the company. For example, if the entity is an educational institution, so the sources of the income would be tuition fees from students, examination fees, documentation fees, or when they are going to ask for documents from the company or from the educational institution, they're going to pay their fees accordingly. So that's other income. For other income of an educational institution, that would be, let's say, there are proceeds from sale of scrap materials. And then a while ago, I've mentioned the sources or main sources of income. So main line of operations of our educational institution. So the other income here would be other sources. All right. Then earnings before interest and taxes, also known as EBIT. So normally EBIT is equal or equivalent to operating profit or operating income. Then pre-tax income, also the same as EBIT. So before our interest and taxes, but then we just have to deduct interest for the pre-tax income. All right. So again, I repeat about that pre-tax income is normally equal to the earnings before interest and taxes and operating profit if without interest. But then if there's interest, that would be the income or earnings already net of our interest, but before we deduct taxes. Then net income or net profit after taxes is, of course, our revenue less all the expenses there, including interest and taxes. So these are just some of the measures of income or terms that we have to know or determine and acknowledge with respect to our income statement. Now, this is the income statement for GPC or Global Petroleum Corporation. From sales less cost of goods sold, take note of the gross profit. If we deduct all our operating expenses, including our classifications of selling and the general and administrative, so this is just anyway how the company presents them or such, but we all know or are aware that even the selling and general and administrative would be part of the operations of our business. Then depreciation equals operating profit. So if we add other income, that would be EBIT. The other income, we all know about this, that in financial accounting and reporting, other income could be added from gross profit or gross income to get the total income. So still resulting to the same EBIT, earnings before interest and taxes. Should we deduct interest expense from there, we get the pre-tax income. Remember a while ago, we said that pre-tax income is same as EBIT if interest expense is equal to 0. But then if there is really interest expense, so deduct that from EBIT and we get the pre-tax income. Then we less the taxes, whether that's current or deferred. Deferred will be tackled in advanced accounting course or higher accounting course. Total taxes equals net income, which is net profits after our taxes. If we deduct the preferred stock dividends or the preference share dividends, these are now the earnings available for our common stockholders or ordinary shareholders. And if we deduct the dividends applicable to them, then this would be the earnings that will be carried forward to our retained earnings. So this particular illustration is extended version of an income statement because for some, they might or normally we might stop at net income or net profits after our taxes. And the other illustrations would be on our other financial statements, like for example, our changes in equity. And then per share data, like the earnings per share, this will be shown under IAS 33 or PAS 33 as a requirement, the basic earnings per share on the face. By the way, this is also a comparative income statement in that we have 2 years. And dividends per share are also shown as well as the price per share. So these are some minimal components of income statement being included, but minimal on the sense that we do not include other comprehensive income, which would make this also much longer. So that, or this would become the statement of comprehensive income. Other items like price per share and dividend per share can be disclosed in the notes, not necessarily on the face of financial statement. Next is statement of retained earnings. As explained a while ago, this is allowed under our current versions of accounting standards if ever the changes for a certain year would only be net income and cash dividends paid or dividends paid. However, if we have more changes in our equity, this would not be allowed and we will be using the statement of changes in shareholders' equity. Then to continue, we have an example here. So retained earnings or accumulated profits and losses beginning. We add our net income to get the total less our dividends, cash to be more specific here from preferred stock or preference share and common stock or ordinary share, and we get our ending balance of retained earnings. Next, for financial statements would be the statement of cash flows that would show to us our 3 main activities. We have OIF as our acronym. We have operating, investing, and financing. And this would show us our changes of cash and cash equivalents for this particular year or during the year. We add with our beginning balance to get the ending balance of our cash and cash equivalents. Now for marketable securities, that would be depending on the case. If the marketable securities are classified as cash under our cash and cash equivalents, then okay, part of statement of cash flows. But if they're expected to be more than 3 months, but 1 year or less, they are part of short-term investments. All right, so notes to financial statements. We have again our explanatory notes, plus additional information like accounting policies, calculations, and transactions, and our underlying entries in the financial statements. For cash flow analysis, this would be tackled in much extent in our next part or series. So we will pause here for now. Thank you very much for listening. Hopefully you got or get something from this session. Thank you very much all and God bless us all.